Imagine that it is 1930. You are not a trader. You are not a speculator. You are not a person trying to beat the market or make a quick fortune. You are a farmer in Nebraska. You worked your land for decades. You sold your harvest. You deposited the money in the local bank because that is what responsible people did. The money is not abstract to you. It is seed for the spring. It is food for the winter. It is protection for your family. It is the result of physical labor, weather risk, patience, and a year of life that cannot be repeated. Then one morning you drive into town to withdraw a small amount for supplies. There is a line outside the bank. People are anxious. The doors are locked. A sign says the bank is closed until further notice. You can see the building, you can see the vault, you can see the place where you believed your money was stored, but the money is no longer available to you. And in that moment you learn a hard truth that most people only learn during crisis. A bank account is not the same thing as money in your hand. A balance is not the same thing as access. This is not the same thing as ownership. This is one of the most important financial lessons in history, and it is still not understood by most people today. When you deposit money into a bank, you are not placing your exact dollars into a vault where they wait for you. You are lending money to a financial institution. The bank records a liability to you. It owes you money. But the cash becomes part of the bank's balance sheet. That is not conspiracy. That is contract law. You become a creditor. In normal times, this distinction feels meaningless. You swipe a card, you write a check, you move money on a phone, you see the balance. The system works so smoothly that access feels identical to ownership, but they are not identical. In a crisis, the difference becomes everything. This is why the history of banking failures matters, not because 1930 will repeat in exactly the same form, but because the basic structure that creates banking fragility has never fully disappeared. It has been managed, regulated, insured, renamed, and backstopped, but it has not been eliminated. Banks still borrow short and lend long. Deposits can be withdrawn quickly. Loans and securities cannot always be converted to cash quickly without losses. Confidence remains the load-bearing wall. When confidence holds, the machine works. When confidence breaks, the machine can fail faster than people think. That is the lesson from 1929, from 1930, from 2008, from Cyprus, from Argentina, from Silicon Valley Bank, and from every banking crisis that teaches the same truth in a new language. The banking system is not evil, it is a machine. But machines must be understood. The mistake ordinary people make is they treat banks as vaults. A vault stores what belongs to you. A bank is different. A bank is a counterparty. It has assets. It has liabilities. It has promises. It has risks. It has regulators. It has political backstops. It has accounting rules. It has capital requirements. It has confidence, and counterparties can fail. This does not mean you should panic. Panic is almost always the wrong response. It means you should think clearly about where your cash is, what risk it carries, and what conditions could make access difficult. During the early 1930s, the United States had thousands of banks. Many were small, local, and deeply tied to the communities they served. People trusted them because they knew the banker, knew the building, and had used the institution for years. Then failures began to spread. The crash of 1929 is remembered as a stock market crash, but the deeper devastation came through the banking system. The market fell sharply, but the banking failures destroyed savings, credit, payrolls, businesses, and confidence. When banks failed, people lost money they thought was safe, not money they had invested in speculative stocks, not money they had gambled, money they had deposited. That is the psychological wound of a banking crisis. It punishes people who believe they were being prudent. Fractional reserve banking explains why this can happen. When a depositor places money in a bank, the bank keeps only a fraction in reserve and uses the rest to make loans or buy assets. This creates credit. It allows economies to grow. It allows businesses to borrow, households to buy homes, and the financial system to expand. In calm times, it is powerful, but it has a built-in mismatch. Deposits are short-term promises. Loans and many securities are longer-term assets. If too many depositors demand money at once, the bank may not have enough liquid cash. It may have assets, but not enough immediate liquidity. If it sells long-term assets quickly, it may realize losses. If depositors see that, panic can accelerate. A bank run is not only a result of insolvency, it can create insolvency. That is what makes confidence so important. If everyone believes the bank is safe, withdrawals are normal and manageable. If enough people believe the bank is unsafe, everyone has an incentive to withdraw first. The rational action of each individual can become a destructive outcome for the group. That is how many systems break. The individual decision is understandable. The collective outcome is disastrous. In the early 1930s, this pattern spread across the United States. Thousands of banks failed. Deposits vanished. There was no broad federal deposit insurance at first. People learned the hard way that the money they thought was sitting safely in a bank was really a claim against an institution that could fail. The government eventually responded by creating the Federal Deposit Insurance Corporation. The FDIC changed the psychology of banking. It created confidence that if a bank failed, depositors would be protected up to a limit that helped stop bank runs because people no longer believed they had to be first in line to survive. That was a major improvement. But it did not eliminate all risk. It changed the risk. Today, many people hear FDIC insured and stop thinking that is dangerous. Deposit insurance is real, but it has limits. It protects up to certain amounts under specific ownership categories at insured institutions. Above those limits, the depositor has a different risk profile. A large uninsured balance is not the same as an insured balance. That distinction matters. The FDIC insurance fund is designed primarily for isolated bank failures, not for every major institution failing at the same time. In a systemic crisis, the government may step in more aggressively. It may borrow, the Treasury and Federal Reserve may create special facilities. Emergency powers may be used. Depositors may be protected beyond formal limits if officials believe contagion risk is high. But that is a policy decision. It is not the same as a permanent legal promise to every uninsured depositor in every circumstance. Silicon Valley Bank made this very clear. A very large share of its deposits were uninsured. When the bank failed, the government chose to make depositors whole using emergency measures and the systemic risk exception. That decision helped prevent contagion, but it also showed that outcomes depend on political judgment, systemic importance, and timing. If your money is above the insured limit, you should not pretend the risk is zero simply because the last crisis was handled favorably. A principle I use in systems analysis is simple. Do not confuse what policymakers did last time with what they are required to do next time. Those are different things. If your bank fails and you have more than the insured amount, the outcome may depend on whether regulators view the failure as systemic, how large the bank is, how politically sensitive the depositors are, what the broader financial conditions look like, and how quickly the authorities want to stop contagion. That is not certainty. That is conditional protection. And conditional protection should be treated differently from guaranteed protection. This brings us to bail. In a bailout, the government uses public resources to stabilize a bank or banking system. Taxpayers bear the burden directly or indirectly in a bail. Certain creditors and uninsured depositors can be used to absorb losses and recapitalize the institution from within. After the 2008 crisis, regulators around the world became less willing to rely openly on taxpayer bailouts. Bail-ins became part of the official resolution framework in many places. The logic is that shareholders, bondholders, and some creditors should bear losses before taxpayers on paper. That can sound fair. But for depositors with balances above insurance limits, the implication is serious. A deposit is a liability of the bank. A liability can be restructured in a crisis. This is not hypothetical. Cyprus showed the world what a modern depositor bail-in looks like. Uninsured depositors in major banks were hit directly. Some balances were converted into bank equity. Access was restricted. Capital controls were imposed. People who believed their bank deposits were money discovered that they were also part of a loss. Absorbing structure. That event matters because it revealed a model. Once a model exists, it can be reused. Again, this does not mean every country will use it the same way. Legal systems differ, political systems differ, banking structures differ, but the mechanism is part of the modern financial toolkit. That is why serious people think about cash storage in layers. They do not ask, where's the safest place? There is no perfect place. They ask, what risks am I trying to protect against and what trade-offs am I willing to accept? That is the right question. Physical cash is one layer. It exists outside the banking system. It cannot be bailed in by a bank. It cannot be frozen by a bank's online system. It can be used during certain kinds of disruptions. In a deflationary banking collapse, cash can become very valuable because prices fall and liquidity is scarce. During the Great Depression, people who had physical cash had flexibility others did not. But cash has weaknesses. It can be stolen. It can burn. It can be lost. It earns no interest. It can lose purchasing power in inflation. It can become harder to use if cash restrictions expand. And in an inflationary collapse, physical currency can be one of the worst assets to hold because the nominal bills remain but their real value disappears. This is why you must define the crisis you are preparing for. In a deflationary credit collapse, cash can be king. In an inflationary currency crisis, cash can be a melting ice cube. The same asset can be safe in one scenario and dangerous in another. Treasury securities are another layer. When you buy a U.S. Treasury bill, note, or bond, you are lending to the U.S. government rather than to a private bank. Treasury securities are widely considered among the safest dollar-denominated assets because they are backed by the government's taxing power, borrowing capacity, and the dollar's role in the global system. They are the collateral foundation of much of the financial world. For people who want to reduce exposure to a single bank, Treasury bills can be a useful alternative to large uninsured deposits. But here too, there are trade-offs. If you hold Treasuries through a brokerage, you have brokerage and operational considerations. The securities are generally segregated and investor protection frameworks exist, but access can still be delayed in a failure or administrative disruption. If you hold Treasuries directly through Treasury Direct, you reduce intermediary exposure, but you may face inconvenience, slower access, and a less flexible system also. Treasuries are still dollar assets. They depend on the credibility of the U.S. government and the purchasing power of the dollar. They may be safe from private bank failure, but not from inflation or currency debasement. That is why Treasuries can solve one risk while leaving another. Money market funds are another tool. They invest in short-term, high-quality instruments and are often treated like cash. Many people use them as cash equivalents. They can be useful for liquidity and yield, but they are not bank deposits. They are securities. In 2008, a major money market fund broke the buck, meaning its net asset value fell below $1 per share. That event created panic and required government intervention to stabilize the system. The lesson is not that money market funds are bad. The lesson is that anything offering yield has structure behind it. You must understand the structure. What does the fund hold? Government securities, prime credit instruments, repurchase agreements, commercial paper, who is the sponsor, what are the redemption rules, could gates or fees be imposed in stress? Again, the answer depends on the structure. A government money market fund is not the same as a prime money market fund, a treasury. Only fund is different from a fund taking more credit exposure. Details matter. Gold and precious metals represent another layer. Gold has been a store of value for thousands of years. It is not issued by a bank. It is not someone else's liability. It cannot be printed by a central bank. It exists outside the banking system if held physically and properly. That makes it attractive in a world of currency debasement, banking stress, geopolitical risk, and distrust of paper claims. But gold is not perfect. It produces no cash flow. It can be volatile. It must be stored securely. If stored in a bank-safe deposit box, access can be restricted during bank closures or holidays. If stored at home, it creates theft and security risks. If stored through a vaulting company, you must trust the custodian. And history includes a very important warning. In 1933, the U.S. government restricted private ownership of many forms of gold under Executive Order 6102. Citizens were required to surrender gold in exchange for dollars. This happened. It is part of the record. So gold protects against certain risks but carries others, including political and storage risk. Silver and other metals have their own characteristics. Silver is more industrial and often more volatile. Platinum and palladium are more specialized. They may play roles, but they are not simple replacements for cash. Foreign currencies and foreign bank accounts are another layer. A person may hold Swiss francs, Singapore dollars, or other currencies in jurisdictions perceived as stable or respectful of property rights. This creates diversification away from one currency and one national banking system. But this too is not free of trade-offs. Foreign currencies can move against you. Foreign banks have their own rules. Foreign accounts create reporting obligations, especially for Americans. Requirements such as FBAR and other tax disclosures can carry severe penalties if ignored. Offshore banking is not illegal when done properly, but it is heavily regulated. The point is not to hide money. The point is to diversify jurisdiction and currency risk legally, transparently, and with proper advice. If you try to use foreign accounts as secrecy, you create fragility. If you use them as compliant diversification, they can create resilience. There is a major difference. Real assets are another layer. Land, property, productive assets, commodities, and things that exist in the physical world can provide protection against certain financial system risks. A farm is not a bank deposit. A house is not a bank balance. Productive land has utility. Real assets cannot be bailed in like a deposit in inflationary environments. Real assets can preserve purchasing power better than cash. But real assets have trade-offs too. They are illiquid. They can fall in price during deflation. They can be taxed. They can be regulated. They can be hard to sell quickly. They require maintenance. They may be tied to local political and legal conditions. You cannot use a piece of land to pay a grocery bill tomorrow morning. So real assets are not cash replacements. They are wealth preservation tools under certain conditions. The uncomfortable truth is that there is no perfect safe haven. Every option has a failure mode. Cash can be stolen or destroyed by inflation. Banks can fail or freeze access. Treasuries depend on government credibility and dollar purchasing power. Money market funds depend on portfolio structure and redemption rules. Gold can be confiscated, restricted, stolen, or difficult to access. Foreign accounts bring currency and compliance complexity. Real assets are illiquid and politically exposed. The investor who understands this does not search for one perfect answer. He builds optionality. Optionality means having more than one way to survive. Some liquidity in the banking system, some exposure below insured limits, some treasury or government-backed liquidity, some emergency cash if appropriate, some hard asset exposure, some real assets, some diversification across institutions and perhaps jurisdictions, some documentation, some plan for access. The proportions depend on the person. A retiree, a business owner, a farmer, a family office, and a young worker have different needs. The principle is the same, but the implementation is different. That is why I do not believe in one size fits all answers. I believe in understanding the machine and matching your structure to your risks. The original lesson from 1929 is not never trust banks. That is too simple. The lesson is do not place all trust in one institution or one mechanism without understanding the structure underneath it. Banks are useful. They provide payment systems, credit, safekeeping, convenience, and financial infrastructure. Modern economies depend on them. You probably cannot live entirely outside the banking system, and trying to do so can create more problems than it solves. But dependence without understanding is dangerous. The system is designed to keep assets inside the system. That is not necessarily malicious. It is how the modern financial world operates. Tax rules, reporting systems, convenience, investment platforms, employer payrolls, social security payments, retirement accounts, mortgage systems, card networks, and digital payment tools all pull people into the system. Once inside, most people never ask what happens in stress. They do not ask because asking feels paranoid. But history shows that the people who maintained options were not necessarily predicting the exact crisis. They simply understood uncertainty. That is a very important distinction. You do not need to predict a bank failure to avoid having all your cash at one uninsured bank. You do not need to predict inflation to hold some assets that can survive currency debasement. You do not need to predict capital controls to understand jurisdiction risk. You do not need to predict a brokerage failure to understand custody. You do not need to predict a bank holiday to think about emergency liquidity. Risk management is not prediction. It is preparation for things that can happen. In every major banking crisis, costs are distributed, but not evenly. Those who know the system early usually have more choices. Those who do not understand the system often become liquidity providers to everyone else. In 1929 through 1933, small depositors in small towns suffered deeply. They had limited information, limited political influence, and few alternatives. They trusted local banks because that was the accepted behavior. In Cyprus, uninsured depositors were hit directly. Ordinary citizens also faced limits on withdrawals and transfers. They did not need to lose all their money to lose control over their money. In Argentina, bank accounts were frozen and deposits were converted into a devalued currency. The middle class discovered that a bank balance can be transformed by government decision. In each case, the details were different. The pattern was similar. People assumed access until access was restricted. They assumed the rules would remain stable until the rules changed. They assumed the money was theirs in a simple way until they discovered that the system had priorities. This is why you must understand hierarchy in a crisis: who gets paid first, who absorbs losses, who can print money, who can change rules, who can freeze transfers, who decides whether depositors are made whole, who has political influence, who has liquidity outside the system. These questions matter more than comfort. The modern banking system is also more interconnected than many people realize. Derivatives, interbank exposures, securities portfolios, repo markets, payment systems, and central bank facilities link institutions together. A problem in one place can move quickly to another. Technology makes this faster. A bank run in 1930 required people to line up physically. A bank run today can happen through a phone. Silicon Valley Bank collapsed in a very short period because depositors could communicate instantly and withdraw electronically. The speed of information and money movement has changed the tempo of banking risk. That is a new feature on top of an old structure. The old structure is maturity mismatch. The new feature is digital speed together. They can be powerful. Interest rate risk is another important part of the modern problem. When interest rates rise sharply, the market value of long-duration bonds falls. Banks that bought long-term securities when rates were low may hold large unrealized losses when rates rise. If they do not have to sell, the losses may remain hidden. If depositors demand cash and the bank must sell, the losses become real. This was a major part of the Silicon Valley Bank story. It was not simply that the bank had no assets. It had assets whose market value had fallen because rates rose. When depositors moved quickly, the bank had to confront losses, confidence broke, and the institution failed. This is the classic banking problem in modern form: long-term assets, short-term liabilities, a change in rates, a loss of confidence, a run, a collapse. Emergency facilities can slow or stop contagion. Central banks can create liquidity, governments can backstop deposits, but these actions do not remove the underlying trade-off. If policymakers keep rates high to fight inflation, pressure remains on some balance sheets. If they cut too quickly to relieve financial stress, inflation and currency pressure can return. There is no painless path. That is the nature of debt cycles. When debt and leverage build up, the system becomes sensitive to interest rates, asset prices, and confidence. Policymakers can move pain around, delay it, distribute it, or print against it, but they rarely make it disappear. This is why I do not look at bank safety as a binary question. People ask, are banks safe? That is too simple. A better question is, under what conditions does my bank, my account, or my cash strategy become vulnerable? That question leads to better thinking. If all your money is below insurance limits at a strong bank, your risk is different from someone with millions uninsured at one institution. If you need daily liquidity, your risk is different from someone storing long-term reserves. If you own a business with payroll obligations, your risk is different from a retiree holding emergency cash. If you have foreign obligations, your risk is different from someone who only spends domestically. If you are worried about inflation, your answer differs from someone worried about deflation. The right cash strategy begins with the right diagnosis. What are you protecting against? Bank failure, temporary frozen access, inflation, currency debasement, government restrictions, capital controls, theft, operational disruption, tax or legal scrutiny. Each risk has different solutions, and some solutions for one risk increase another. Holding physical cash reduces bank access risk but increases theft and inflation risk. Holding treasuries reduces private bank credit risk but keeps dollar and government risk. Holding gold reduces currency and banking risk but increases storage and political risk. Holding foreign currency reduces domestic currency concentration but adds exchange rate and reporting risk. Holding real assets reduces financial counterparty risk but reduces liquidity. This is why a balanced structure matters. Not because it maximizes return, because it reduces dependence on one fragile assumption. A good structure does not say, this one thing will save me. It says, I do not know which stress will come, so I will not let one point of failure determine my outcome. That is systems thinking. The people who are hurt most in crises often did not make one obviously reckless decision. They simply had no redundancy: one bank, one currency, one jurisdiction, one access point, one assumption, one belief that the system would always function as it had yesterday, then yesterday ended. The future did not ask permission. This is why I believe in simplicity and redundancy. Keep some cash accessible for short-term needs. If that fits your situation, keep bank deposits within insured limits where practical. Understand ownership categories and insurance rules. Use more than one institution if balances are large. Consider treasury bills or government money market funds for excess liquidity depending on your needs. Understand the structure of any money market fund you use. Keep important documents organized. Do not let all liquidity depend on one online login, one card, or one institution. Think about inflation and purchasing power. Consider whether some hard assets or real assets fit your long-term plan. If you use foreign accounts, do it legally and report properly. If you use precious metals, solve the storage and access question before buying. If you hold real assets, understand liquidity and taxes. None of this is dramatic. But that is the point. Risk management should be boring before the crisis so life can remain manageable during the crisis. The opposite is what most people do. They ignore boring risk during calm times, then make dramatic decisions during panic. That is usually expensive when the bank is already failing. It is too late to calmly diversify. When capital controls are already announced, it is too late to move money freely. When inflation has already destroyed purchasing power, it is too late to wish cash had been productive. When everyone wants treasuries, gold, liquidity, or safe collateral at once, prices and access change. Preparation must come before the bottleneck. That is why history matters. History gives you the autopsy before you become the patient. It shows the mechanisms of failure while you still have time to adjust. But history must be used correctly. The lesson is not that 1929 will repeat exactly. The lesson is that human beings repeatedly trust systems they do not understand, and those systems repeatedly reveal hidden fragility under stress. The language changes. Deposit insurance, resolution authority, bail in framework, emergency lending facility, systemic risk exception, capital control, liquidity backstop. These phrases sound modern and technical, but underneath them is an old question: who bears the loss? When the promise cannot be honored in the normal way, that is the question every crisis answers. In calm times, everyone assumes someone else bears the risk. In crisis, the risk is assigned, sometimes to shareholders, sometimes to bondholders, sometimes to depositors, sometimes to taxpayers, sometimes to currency holders through inflation, sometimes to savers through negative real rates, sometimes to future generations through public debt. Losses do not disappear, they move. The system's job is often to decide where they move. Your job is to avoid being the easiest place for them to land. That does not mean avoiding all risk. That is impossible. It means understanding which risks you are taking and why. If you hold bank deposits, you are taking bank and insurance structure risk above limits. If you hold treasuries, you are taking government and currency risk. If you hold physical cash, you are taking theft and inflation risk. If you hold gold, you are taking storage, volatility, and political risk. If you hold foreign accounts, you are taking jurisdiction, currency, and compliance risk. If you hold real assets, you are taking liquidity and local political risk. There is no risk-free asset in the absolute sense. There are only different types of risk. The mistake is thinking that the familiar risk is no risk. Bank deposits are familiar, so people think they are riskless. Cash is familiar, so people think it is safe. The dollar is familiar, so people think it cannot be diluted. The local bank is familiar, so people think it cannot fail. Familiarity is not safety. Structure is what matters. This is where the modern investor must become more sophisticated. Not complicated, sophisticated. Sophistication means knowing the simple mechanisms underneath the surface. A bank deposit is a claim. A bank is a counterparty. Deposit insurance has limits. Liquidity is not the same as solvency. A government guarantee depends on capacity and policy. A currency can lose purchasing power. A safe asset can be unsafe under the wrong scenario. Diversification is not about maximizing excitement. It is about reducing dependence. Optionality is valuable because the future is uncertain. These are principles. If you understand them, you can make better decisions without fear. Fear says, take everything out of the bank. Principles say, understand insurance limits, liquidity needs, institution strength, and alternatives. Fear says, buy only gold. Principles say, gold solves some risks and creates others. Fear says, cash is king. Principles say, cash is powerful in deflation and weak in inflation. Fear says, treasuries are perfectly safe. Principles say, treasuries reduce bank risk, but keep sovereign and currency risk. Fear says, foreign accounts are the solution. Principles say, foreign accounts can help if legal, compliant, and properly structured, but they add complexity. This is why I prefer calm analysis. The system has risks, but panic is also a risk. Many people lose money not because the crisis destroyed them directly, but because their emotional reaction to the crisis destroyed them. They sold assets at the bottom. They moved money into poor structures. They ignored tax rules. They bought assets they did not understand. They concentrated in one hedge that failed under the actual scenario. A good plan reduces the need for emotional improvisation. That is the real value of preparation. You decide in advance what role each asset plays. Bank deposits for payments and insured liquidity, physical cash for limited emergency access if appropriate. Treasuries or treasury funds for low credit, risk dollar liquidity, money market funds with understood structure for yield and liquidity, gold or precious metals for currency and system hedge, sized carefully, foreign currency or foreign accounts for jurisdiction and currency diversification, if appropriate and compliant, real assets for long-term purchasing power and utility. No one layer is perfect together. They can create resilience. The right mix depends on your life. If you are managing a household, you need access and simplicity. If you are managing a business, payroll and operating liquidity matter. If you are retired, capital preservation and access matter. If you have large uninsured balances, bank diversification matters. If you are internationally exposed, currency and jurisdiction matter. If you fear inflation, productive and hard assets matter. If you fear deflation, high-quality liquid cash, like instruments matter. A good plan begins with your actual needs, not a generic headline. The 1929 farmer did not need a theory. He needed access to his money. He needed the system to function. When it failed, he had no options. That is the point. Options are built before they are needed. The time to think about where cash should be stored is not when the line forms outside the bank. It is when the doors are still open. The time to think about insurance limits is not after the bank fails. It is when you decide where to place deposits. The time to think about liquidity is not during a freeze. It is when you design your cash structure. The time to think about inflation is not after your purchasing power is gone. It is while you can still allocate. The time to think about documentation is not when the account is questioned. It is before money moves. This is the essence of risk management. Do the work early, make the system boring, remove single points of failure. Then if stress comes, you have choices. Choices are wealth. In a crisis, people often discover that net worth and usable wealth are not the same. You may have assets, but if they are illiquid, frozen, impaired, or inaccessible, they may not help when you need them. That is why liquidity quality matters. Not all liquidity is equal. A bank balance may be liquid until the bank is closed. A money market fund may be liquid until redemptions are gated. A brokerage account may be liquid until operational delays occur. Gold may be valuable but not easily spendable. Real estate may be valuable but not quickly convertible. Foreign accounts may be useful but not simple if reporting or transfer rules interfere. So you need different liquidity forms for different scenarios. That is the mature approach. It may feel excessive during calm times, but calm times are when resilience is cheapest. When everyone wants safety, safety becomes expensive or inaccessible. When everyone wants liquidity, liquidity becomes scarce. When everyone wants out, the exit narrows. That is why you prepare when others are comfortable. Now let me return to the core psychological lesson. Most people think the danger is that they will make a bad investment that can happen. But another danger is that they will misunderstand the thing they thought was not an investment at all. A bank deposit feels like it is outside risk. It is not. It is low risk under normal conditions and within insured limits. But it is still inside a system. It is still exposed to rules. It still depends on functioning institutions. It still depends on access. It still depends on confidence. If you treat it as absolutely riskless, you may keep too much there without thinking. If you understand its role, you can use it properly. That is the point. Banks should be used, but they should be understood. Deposit insurance should be valued, but it should not be misunderstood. Treasuries should be considered, but they should not be worshipped. Gold can hedge, but it should not become a religion. Foreign accounts can diversify, but they should not be used casually. Real assets can preserve value, but they are not immediate cash. Every tool has a role. The disciplined person assigns roles before stress. The undisciplined person grabs tools during panic. This is why I study cycles. The same human behavior repeats in good times. People maximize convenience and yield. They ask, where can I get the best rate? They do not ask, what happens if access is restricted? They do not ask, what happens if rates change the bank's balance sheet? They do not ask, what happens if this institution is not systemic enough to be rescued? They do not ask, what happens if the fund gates redemptions? They do not ask, what happens if the currency loses value? They do not ask, what happens if I need money on a weekend during a banking panic? Then a crisis arrives and everyone asks those questions at the same time. That is too late. The purpose of history is to ask the questions early. The lesson from 1929 is that safety is often assumed until it is tested. The lesson from 2008 is that highly rated assets can fail when the underlying structure is misunderstood. The lesson from Cyprus is that uninsured depositors can be part of the loss-absorbing mechanism. The lesson from Argentina is that governments can freeze and convert deposits when the system is under pressure. The lesson from Silicon Valley Bank is that modern bank runs can happen at digital speed and that uninsured deposits depend on policy decisions. These are not isolated stories. They are stress tests of assumptions. The assumption that banks are vaults. The assumption that deposits are always accessible. The assumption that insurance covers everything. The assumption that regulators always prevent failure. The assumption that government support is automatic. The assumption that cash is always safe. The assumption that the old rules will hold in a new crisis. A serious investor replaces assumptions with principles. Principle 1, understand counterparty risk. Principle 2, respect insurance limits. Principle 3, diversify access points. Principle 4, hold some liquidity outside fragile channels if appropriate. Principle 5, match assets to the crisis you are preparing for. Principle 6, do not rely on one currency, one institution, or one legal regime more than necessary. Principle 7, keep records and stay compliant. Principle 8, accept that every safe haven has trade-offs. Principle 9, prepare before panic. Principle 10, do not confuse confidence with certainty. These principles do not make you invulnerable. Nothing does. They make you less fragile. And less fragile is often enough. If a crisis never comes, the cost of reasonable preparation is usually modest. You may have a slightly more complex cash structure. You may earn slightly less yield on some emergency reserves. You may spend more time organizing accounts and records. If a crisis does come, that preparation can be the difference between calm and panic. That is a good trade. The mistake is to optimize only for the world where nothing goes wrong. Many financial systems are optimized for calm. Higher yield, maximum convenience, minimum friction, single platform, single bank, no redundancy, that is efficient. But efficiency and resilience are not the same. A system with no redundancy can be efficient right up to the moment it breaks. Nature teaches this. Markets teach this. Debt cycles teach this. Banking crises teach this. Resilience requires some redundancy, some spare capacity, some backup liquidity, some diversification, some inconvenience. That inconvenience is the price of not being trapped. Now, I want to be careful about one thing. This does not mean the banking system is about to collapse tomorrow. It does not mean you should withdraw all your money. It does not mean you should stop using banks. It does not mean you should make decisions based on fear. The banking system has many safeguards today that did not exist in 1930. Deposit insurance exists. Central banks act more aggressively. Regulators monitor institutions. Emergency lending facilities can be created. Large failures can be managed in ways that reduce contagion. Those improvements matter. But improvements are not elimination. The system is safer in some ways and more complex in others. Modern backstops can reduce one type of crisis while creating another, such as inflation, moral hazard, political backlash, or currency debasement. There is always a trade-off. A central bank can provide liquidity, but liquidity creation can affect the currency. A government can guarantee deposits, but guarantees create fiscal risk. A bailout can stop panic, but it can shift costs to taxpayers or currency holders. A bail-in can protect taxpayers, but it can hurt creditors and uninsured depositors. There is no costless rescue. That is what people must understand. The question is not whether someone will pay. Someone always pays. The question is who, how, and when. A thoughtful person tries not to be the uninformed person who pays because he never understood the structure. That is why the phrase "where to store cash when banks fail" is not really about finding one place. It is about building a cash and liquidity system that recognizes multiple failure modes. If the bank fails, what do I have? If the currency weakens, what do I have? If inflation rises, what do I have? If access is temporarily frozen, what do I have? If digital systems fail, what do I have? If I need to move money quickly, what do I have? If my heirs need to find assets, what do they know? If a regulator asks for documentation, what can I prove? These are the real questions. A simple answer cannot cover them all. A layered system can. The farmer in Nebraska lost because he had one door. The door closed. The modern investor should have more than one door. That is the central lesson. One door is not resilience. One bank is not a cash plan. One insurance limit is not a wealth strategy. One asset class is not a safe haven. One assumption is not enough. The world is uncertain. The financial system is complex. Policymakers are constrained. Banks are leveraged. Currencies can be debased. Governments can change rules. Markets can freeze. People can panic. None of this is new. The names change. The structure repeats. And the people who do best are usually not the people who predicted the date of the crisis. They are the people who understood that systems can fail and prepared without needing a forecast. That is the mindset I would want every person to have. Do not wait for certainty. Certainty arrives after the opportunity to prepare has often passed. Prepare for uncertainty. That is wiser. If you keep cash in banks, understand the bank. If you exceed insurance limits, understand the exposure. If you use money market funds, understand the holdings. If you buy treasuries, understand custody. If you hold gold, understand storage and political risk. If you hold foreign accounts, understand reporting. If you hold real assets, understand liquidity. If you hold physical cash, understand theft and inflation. If you hold everything in one place, understand concentration. The purpose is not to be fearful. The purpose is to be accurate. Accuracy is calming. When you know what each part of your system does, you are less likely to panic. You are also less likely to make naive assumptions. You can look at a crisis and say, this is the part of the system being stressed. This is the layer I built for that. This is what I do next. That is far better than knocking on a locked bank door and learning the rules after the fact. History gives us the warning. The modern system gives us more tools, but tools only help if we use them before stress arrives. So the lesson is not that banks always fail. The lesson is that banks can fail. The lesson is not that deposit insurance is useless. The lesson is that deposit insurance has limits. The lesson is not that cash is always best. The lesson is that access matters. The lesson is not that gold solves everything. The lesson is that no single asset solves everything. The lesson is not to run from the system. The lesson is to understand the system and avoid being fully dependent on one fragile part of it. That is how I think about cash when banks fail. Not as a single hiding place, as a framework of access, liquidity, insurance, counterparty risk, purchasing power, jurisdiction, documentation, and optionality. If you build that framework calmly, you do not need to be controlled by fear. And if the next banking crisis comes, whether it comes through interest rate losses, deposit flight, credit problems, policy mistakes, currency stress, or something no one has named yet, you will have a better chance of responding with clarity, The system may be stronger than it was in 1929. But the basic law remains: when too many people want out at the same time, not everyone can get out through the same door. Your job is to understand where the doors are before the crowd starts running. That may be the most important lesson from 1929, and it may be one of the most important lessons for anyone trying to protect cash in the world that is coming next.